Hey, hello, Jack Tubbs from the J Team at Realty One and Surprise, Arizona, coming to you on this very warm Tuesday here in the Valley in Phoenix, Arizona. Hey, a couple things I want to share with you, and I really want to talk to buyers today, but I probably sellers alike. I'd like to go over a few lending terms that I want to make sure that everybody's clear on their understanding, because I know that it seems like every time we talk to a lender, there's new terms, there's new vocabulary, and not everything is really clear and easily understandable. But first off, let's start with some of the basic stuff, just so that you buyers understand when a lender's talking to you, this is what they mean. And I'm going to bet that I'm preaching to the choir here, but nonetheless, I like to share this kind of stuff just to make sure that people have got a grasp on what a lender is telling them. First up, we talk about term. What is the term? Well, mortgages are generally, they're broken up into different terms of length. And you have a term such as 15, 20, or 30-year terms. In general, the larger the term, the lower the monthly payment. However, shorter terms mean that you pay less in interest over the entire life of the loan. And you're also going to see rates raise a little bit the longer the term. You're going to see a difference between a 15-year mortgage and a 30-year mortgage. Now, fixed versus adjustable rates. Now, we talked about rates, interest rates. They do change over the length of the loan. As I said, a 15-year term loan is going to have a lower interest rate than a 30-year term loan. It's going to have a higher interest rate, and that's why a lot of people, if they can afford to do a 15-year loan, they do it because it saves them a lot of interest money over the life of their mortgage. Now, we have fixed and adjustable rates. Now, what does that mean? Well, basically it means that one rate is going to be fixed throughout the entire length and life of the mortgage. Now, an adjustable rates usually offer a lower rate, but it will rise as the market interest rates go. And if it's not capped by so much, it can go well beyond what your fixed rate mortgage may have started out at. Now, most adjustable rates will start at a lower rate, and they'll still be at like a 30-year term, but they'll be able to raise the term as time goes by. So that's why a lot of people are not big on adjustable rate mortgages, or ARMs as they're called in the lending industry. Sometimes they can be a good thing depending on how much the rate drops, and if you're planning on financing your home, say within the first 5 years of the mortgage. That way you can usually head off any raise in interest rates that would take you out of what a fixed rate mortgage would have been. So that's the difference between fixed and adjustable rates. Fixed, it's the same interest rate through the entire life of the mortgage, whether it be a 15 or 30, that interest rate is going to stay the same. Adjustable rates, or ARM, is going to start at a lower rate, but it's going to raise over time, and it's going to follow whatever the bond market is doing. And if the bond market goes up, that interest rate is going to go up with it. Usually we try to negotiate some areas where it's going to be capped, or how much it can raise per quarter or per year. But we found out throughout most adjustable rate mortgages that they tend to top out above what a fixed rate would be. So not always the right lending product for everybody. Can be for somebody who's planning on refinancing, say within the first 5 years of the mortgage. Non-traditional mortgage, sometimes they're called exotic mortgages. These mortgage types are common with the run-up to the housing crisis. They feature a lot of different loans, like no documentation, low down payments, all these other different things, and they're usually done by non-traditional lenders, which means not mortgage brokers or mortgage banks, but they're done by investors who pool a lot of money together to lend to people, mainly to do investment-style properties, flips, being rental properties, it's stuff like that. And they're exotic, and their terms are different, and sometimes they're no doc and all that kind of good stuff, and they can serve a useful purpose, especially in an investor's life. But for somebody purchasing a home, I would say these are things that you kind of might want to shy away from, because they do have terms that you may not want to deal with further on down the road. A balloon mortgage. This is a form of a non-traditional financing. Basically what it is that it starts out at a very small portion, but after a certain amount of time, and usually 7 years is the year, They let you finance the property for 7 years at a fairly low rate, based sometimes interest only, but then they want the balance of what's left over in the loan at the end of the 7-year term. Sometimes you see them at 15, but it makes for a very low payment for the first 7 years that you own the property, but then they want you to come up with the entire balance of the mortgage at the end of the 7th year. Now, this is a good thing if you want to start out with a low payment, or if you're only planning on staying in the property in the short term, or if you know that you've got a business to sell and you're going to have a lot of ready cash to pay off the mortgage at the end of 7 years, or if you know that you're going to be able to refinance, put a lot down and refinance at the end of the 7 years and be able to pay off that balance. Okay, these are the terms I want to go over with today. I got probably 3 or 4 more terms I want to go over with you tomorrow. And hey, if I can help you find a lender, I work with 3 excellent lenders throughout the Valley. Just give me a call. You can call me direct at 248-330-7972. That's 248-330-7972. Or you can email me, jack@thejteam.house. That's JACK @THE letter J, the word team.house. Or you can call the office, talk to any of my team members. They'd be more than happy to refer you to a lender or help answer any of your questions. And you get a hold of them at 623-252-4061. That's 623-252-4061. Hey, this is Jack Tubbs from the J Team in Surprise, Arizona, wishing you a fantastic Tuesday. Stay cool, especially not only today, but the rest of this week. And I'll see you tomorrow with more about what's going on in the Phoenix real estate market.